Over the last 20 years, if we strip out the rescue rights issues for British banks, you discover that more money has been taken out of the stock market by British companies than has been raised for it.
The chain of intermediation has now become extraordinarily long. When I began, I said that markets were for users, and the users of equity markets are companies at one end of the chain and savers at the other.
Over the last couple of decades, companies have become more and more locked into a dysfunctional cycle of earnings guidance, earnings management, quarterly earnings reporting and the like. A cycle that can have very little connection in many cases with what is actually going on in the underlying business.
But in between, there are today registrars, custodians, there are nominees, there are asset managers, there are fund of fund managers, there are pension fund trustees, there are insurance companies, there are investment consultants, there are other people who are providing wraps, there are platforms, there are IFAs, the list goes on.
We've regulated the pension sector in the last 2 decades in a way that was all well-intentioned, but has not actually in the long run served the interests of UK pensioners well, or indeed at all, far less the interests of UK business. And I think most of all, what we need from pension fund trustees is a willingness to find asset managers that they can trust and leave them to get on with it.
We need, I think, to rethink the ways in which the financial system does and can serve the needs of the real economy. We all need a properly functioning financial system. All the evidence we have from history around the world is that without an effective financial system, economic growth cannot happen. But that doesn't mean that the more trading there is in a financial system, the more prosperous an economy we have. And I think the experience which we've had of the way markets has evolved in the last 2 decades ought to indicate that to us. Thank you.